Good morning, everybody, and welcome to the second in this series of IMAP webinars on the tools we use for portfolio management. What we've tried to do in this series is drill down to the technology issues which face managed account portfolio managers. On Monday, we looked at the tools that could be used for portfolio construction and research and analysis of portfolios. Today, we're going to talk about really where the rubber hits the road. We're going to talk about the actual operation of managed accounts, particularly in a platform context, but more broadly than that. And then next Friday, on Friday, we're going to be talking about client reporting, risk measurement, and portfolio measurement. So what we've tried to do in this series is to draw together all aspects of operating managed accounts and to highlight the technology which portfolio managers use for that. Before I hand over to Nancy Ewan from SS&C, who's been our moderator for this whole series, let me just tell you a little about the upcoming events for IMAP. Next month, the webinar series will focus on what I think is an absolutely crucial aspect of advice, and that's building a client base, including wholesale and not-for-profit clients. For many advice businesses, that's a really key issue for them to address. Then in June, we'll be focusing on asset allocation. But in May, we'll go back to live conferences, Brisbane, Sydney, and Melbourne, for our Advisor Roadshow on the business of operating advice practices, and in particular, how managed accounts play into that. Then in August, we'll be announcing the IMAP Managed Account Awards. I'd encourage you to ask questions through the course of today's webinar. And to do that, at the bottom of your screen, you'll see a Q&A button. Type in questions, and the presenters will see those and deal with them as we go. So now it's my pleasure to hand over to Nancy Ewan, responsible for GWP, their global wealth platform. This is the tool that SS&C make available to portfolio managers, brokers, and investment managers, which offers a wide range of capability for portfolio management, both on and off platforms. So Nancy, over to you, and thanks for hosting today's session.
Thank you, Toby. Hi, everyone. And again, welcome to IMAP's three-part webinar series on the topic of the tools we use to manage portfolios. So I'm your moderator, Nancy Ewan. As Toby has introduced myself, I'm the product manager of SS&C Technologies GWP. As Toby mentioned, today's our midweek webinar today, we're focusing on the topic of portfolio management and trading. The key concepts we would like you to take away from today's session is how we manage portfolios, managing IMAs, and engaging advisors and working with other organizations. So as part of today's agenda, we are very fortunate to have with us today two experts within our panelists who have different methods on how they manage their clients' portfolio and trade. So it's my pleasure to welcome our panelists for today. Our first panelist is Adrian Rowley, who is a portfolio manager and equity strategist within the WATERSHED Funds Management Investment teams. Adrian is a specialist in the delivery of managed account solutions with over 15 years experience managing funds across multiple platforms, structures, and asset classes. Adrian is the portfolio manager for the WATERSHED Australian Share SMA and Income SMA and a member of the Asset Allocation, International Share and Emerging Leaders Investments teams. He'll be presenting the evolution of WATERSHED's journey from IMA to SMAs whilst leveraging of various platform technologies to manage portfolio and trade. Our second and last panelist for today is Chris Smith, Head of Investment Services at Implemented Portfolios. At Implemented Portfolios, he oversees a team who is responsible for the implementation of client portfolios and custody of their assets. Chris is a specialist in the delivery of individually managed accounts with over 15 years experience managing the implementation of portfolios globally across multiple asset classes and structures. So prior to joining Implemented Portfolios, Chris has held a variety of roles within financial markets, from equities and derivative dealing through to investment advice for high net worths and wholesale clients. Today, Chris will be providing his view on how Implemented Portfolios manages MDA IMA style portfolios while utilizing off-platform and on-platform technology. As a close client of SS&C Technologies, Chris and I have been lucky to have the opportunity to work together in the last couple of years. And lastly, to conclude our webinar, we'll have a Q&A session with the panelists. So please feel free to send questions throughout the session by clicking on the Q&A icon at the bottom of the screen. So over to you, Adrian.
Thank you very much for having me. You can probably flick through the first 3 slides reasonably quickly. So it's just a bit about who we are, and then a disclaimer, of course. And if you move to the following slide, I'll get underway. So I just want to thank you all for having me. I just want to give you a very quick snapshot of what we do, the mandates that we run, and then move on to the platform technology that has really evolved rapidly over the last sort of 5 to 7 years that now enable us to run, diversified and fairly sophisticated managed account models. So we were established in June 2009, which makes us one of the oldest managed account providers. But importantly, everything that we do is on platform. So all of our models are on platform under a managed investment scheme structure, both personal and super. So we have our full suite on Hub24, Premium, OneView, and Fiducian, and our sector models or single mandates on NetWealth, Mason Stevens, and Explore Wealth. So very briefly, we run 4 sector-based separately managed accounts, SMAs. So there's a direct international share portfolio, a large cap Aussie, a mid cap Aussie, and an income portfolio. Now they're all fairly concentrated portfolios. There's sort of 20 to 25 stock portfolios. So they're our sector-based SMAs. What we then have is 3 multi-asset or diversified portfolios that are built predominantly from those SMAs, with some external funds and ETFs for parts of the market that we don't cover. So there's a conservative, a balanced, and a growth model. Now, when I get to the evolution of technology, the platform technology that enables us to run that now is brilliant, and we call it a models of models technology. We also build some bespoke portfolios for some larger groups that again are investment options on platform that we run with those groups in an asset consulting capacity. And giving us a bit of an unashamed plug here, but our multi-asset models have significantly outperformed all of our mainstream sort of much larger competitors. So really what we're trying to provide, and I guess what everybody in the industry is trying to provide, is through this managed account structure, we want to provide an active or dynamically managed portfolio. We want to do better than index. We want to deliver it at a low cost or a reasonable sort of price point, again, which this managed account technology now enables. And we want to deliver sort of strong performance. So, they're the 3 key kind of goals that we're trying to achieve. And the flip side of that is that, our model should drive a lot of practice efficiency for advisors. If you could move to the next slide, please. So managed accounts, and I'll give you just a quick rundown of the sort of technology evolution that we've been through in our business, and it should help you to understand, I guess, the managed account structure in a bit more detail if you don't use SMAs or managed accounts. So if we go back, nearly 12 years ago now, we ran IMA, so individually managed account portfolios under a managed discretionary account structure. So effectively with the platforms, we would just use them as the source data. So we would get a dump from platform every day. of all of the client's holdings. And then we built internally pivot tables to allow us to manage portfolio weights. So for example, all of the client holdings would come in, we'd build a pivot table to say, right, what should be in Aussie equities, what should be in the large cap equities, what's the weight, what does the client currently have, and what's the variance. Then if we wanted to make a change, it would calculate, the amount that we needed to buy or sell across every client account. We'd bulk those up and then put those through a broker. And then the broker would report back to the platform. So that's effectively, the first, I guess, evolution of the managed account offering that we had. So we were creating some efficiency by being able to bulk up all of these orders and do the reweighting ourselves, but it was still pretty clunky. And you're also individually transacting on client accounts, which means you have individual transaction costs. About 9 years ago now, the first sort of SMA or separately managed account technology was built at Platform. For us, that was absolutely brilliant. What it meant was that we could set up sector-based models. So we could say, right, here's our large cap Aussie SMA, for example, here's our 25 stocks and weights. And the client could have an allocation to that SMA. So what that meant is we're then moving away from transacting individually at client accounts to be able to transact at the portfolio level. So we can make a change to that portfolio. It's one line of stock that's pushed through and traded, and the platform then determines, what's bought or sold for each of the underlying accounts. So brilliant efficiency for us. Means that you can run far more diversified portfolios. It means that you can manage much smaller transactions and rebalances. So you can add to positions progressively, reduce positions progressively, or put through multiple transactions. So a huge efficiency there in transacting at the portfolio level rather than the client level. What it meant though that if we set up sector-based models to do an asset allocation change, we still had to do that at the individual client level. So there was a gap there. About 5 to 6 years ago, we worked with one of the platforms to roll out what we call a models of models technology, and they've all pretty much all developed this now. So what that means is we could then put together a diversified portfolio built from SMAs, so from our sector-based SMAs, plus anything else that we want to put in there, any other funds, any other ETFs, and we can manage a diversified portfolio, both at the model portfolio weight and at the underlying sector level. And I'll just quickly show you how that works. So that's been a huge efficiency, which means that it's provided real scale for our business in running multi-asset portfolios at the portfolio level rather than the underlying client level. You've got genuine scale, and the technology at Platform is continuing to develop, and they're getting some really cool sort of functionality, enabling you guys as advisors to sort of customize portfolios where you need to, things like stock substitution and replacement. Things like ESG preferences, which I think we'll touch on later, and even fractionation, which a few of them are looking at now. So rather than having to buy, one Amazon or Google share at $2,000 or $3,000 or $4,000, you'll be able to hold a fraction of a share, which then means that you can start to run model portfolios at a smaller price point or lower size. Next slide, thank you. So I'm just going to show you this quickly, how this works, to show you the kind of efficiency that we have. So this is just a slide that shows a model portfolio weight for us. So I think it's our balanced or growth portfolio. So you can see there that we simply have a last submitted weight, current weight to each of those sector-based SMAs. So you can see the international share, the Aussie share, the income, the emerging leaders, our international ETF, which we use ETFs for rest of world exposure, our alternatives bucket, so there's a couple of funds in there. So we can put whatever we want into these sector buckets. And if we wanted to make an asset allocation change, it's as simple as putting in the new weight and then submitting that. Now, to give you an example, we're actually this week making a change to our portfolios. We're taking a little bit of money out of the emerging leaders or mid-cap portfolio after a huge run and reallocating that to large cap global equities, given a bit of weakness in parts of the US market and dollar back at 78 cents. Now, in implementing that change, in taking a few percent out of mid-cap, a few percent into large cap international, now the platform will effectively be selling part of 20 or 25 mid-cap stocks and buying part of 20 or 25 international equities. So there could be 50 transactions in that rebalance, but for us, it's as simple as putting in that weight change, and then those trades will be executed over the course of the day. If you could flick to the next slide. So you can see managing at the portfolio level is really efficient for us now, and it's also efficient for us to be able to build bespoke solutions as well. And then the underlying sector models, this just gives you a view of the investment managers portal at one of the platforms. So it's exactly the same thing. So we can jump in there at any point in time and say, okay, well, Apple was 6.7% of the portfolio of the international equity sector-based SMA. It's 7% now. If we want to make a change to that, increase it or decrease it, it's as simple as putting in that new weight, submitting it, and then that order will be placed overnight. So you can see that technology there. What it allows us to do is to manage dynamically at the asset allocation level and at the underlying security level across a broad investment universe really quickly and efficiently, and the platform effectively does all of the engine work in managing the underlying client weights. If you could jump into the next slide, thanks. So effectively, the end result here, and I've gone through this reasonably quickly and happy to take questions, but the end result is that this technology really enables us to run diversified risk-based models or bespoke portfolios. Now, with our multi-asset model, there's about 130 underlying securities in that portfolio. So you as the advisor or the client actually have full transparency. You can see all of those holdings. So it looks very much like a customized personal portfolio. But from our end, it's incredibly efficient to manage. So we can, like last year when markets are gapping down, we can progressively make asset allocation changes and underlying security changes as often or as regular as we need to, which becomes particularly important when you've got really, really dynamic markets. So effectively, that's the structure that we've got. That's what we do and how we deliver those portfolios to you guys. Internally, we run all the portfolios through Bloomberg, so we get all of our weights there, all of our attribution analysis, any risk or scenario modeling that we want to run. Like any fund manager, we use FactSet for our asset allocation reporting and capital markets assumptions and those sorts of things. So, they're the tools that you would expect any sort of fund manager to use. But the tools that we use to actually manage accounts for you guys are all that platform. Again, what that means is we don't have lots of admin, lots of people transacting, doing all that here. We have a team of portfolio managers with some support staff and really outsource that capability to the platforms that you guys use. That's me. Thank you.
Thanks, Adrian. We did have a couple of questions that just came through. If you don't mind answering them now before I pass it over to Chris.
Sure.
So with regards to the journey IMA, MDA to SMA, does that mean you went from a HIN base to custody base? Can you outline more so? And you can, of course, do HIN base SMA. However, when you talk fractional trading, I'm correct. Correct, it's now custody.
Yeah, he's spot on it. We went from HIN based. Well, actually, we actually went from issuer sponsored because with HIN based, you were linked to one broking account. So we use half a dozen brokers. So we were actually all issuer sponsored so that we could transact through whichever broker to custody. So it's all custody on platform now. And when we transact now, it's interesting. It varies from platform to platform. Some of them just push it through market using UBS and get VWAP in the afternoon. Excuse me. With some of the platforms, we can pull those orders out and we can actually execute through brokers that we want to and manage those orders a bit closely. But yeah, you're spot on. It's all custodial now.
Yeah. Okay, and then we have another question just in regards to at Watershed, what is the technology that's being used, and is it available to the public or is it all in-house?
Okay, so no, it's not available to the public. So in running the portfolios, we use the platform technology. So we have an investment managers portal or log in with each of the platforms. So that's different to the advisor portal and the client portal. So that effectively allows us to manage the portfolio weights. But behind the scenes, the software that we use, as I mentioned, is Bloomberg and FactSet to run all of our portfolios here, as well as just our normal investment process.
Thank you, Adrian. And also the screenshot that you shared earlier on, those are all the platform screenshots that you have access to today that you just mentioned, right? That was another question that came through.
That was just one of them. So that was just a screenshot from one of the platforms that we use, and the screen that we use to manage weights. But it does vary across each platform. They're all slightly different, but it's the same basic functionality that they have.
Right. Okay. Thank you. Lastly, one last question before we move over to Chris. Could you please expand on the transaction costs of rebalancing portfolios?
Yeah, actually, really important question. And again, for us, that's one of the benefits of moving from the IMA structure to the SMA structure, because a lot of platforms, if you're transacting via HIN, most brokers will have a minimum transaction cost. If you're transacting individually on a client portfolio platform, usually there's a minimum transaction cost. Once you move into the SMA world, there is no minimum transaction cost. It's just basis points. So most of the platforms, they range from sort of 7 basis points up to about 20 basis points as a brokerage cost. So really important point. So if we're making a change to the portfolios or a meaningful asset allocation change, then there can be a lot of transactions, but it doesn't incur any additional cost at all. So that's one of the benefits of being in the SMA structure and in that custodial environment.
Okay, thanks, Adrian. So I'm just going to pass it over to Chris Smith now from Implemented Portfolios.
Thanks, Nancy. And Adrian, good to hear from you and what you were going through there. I'm going to run through quickly a very high level of what Implemented Portfolios does and how we do very similar things to what was just spoken about, and where we are slightly different in how we approach things. So if we can go to the next slide. As a starting point, what we run is a managed discretionary account service, and it's good to sort of frame that to understand where we sit in relation to the end client who's investing with us and the financial advisor who's typically distributing it. So the financial advisor and Implemented have a distribution agreement in place between each other. Implemented and the end client who's investing have a MDA agreement in place, but the advice sits firmly with the financial advisor and the client. So that relationship between the client and the advisor is their relationship, and that sits separately from Implemented Portfolios. Our service is really to the financial advisor and assisting them in taking their business into an MDA environment and to gain scale into their business. So we deliver our MDA through an IMA. So sort of that first iteration that Adrian was talking about, we're still, we see the benefits in running an IMA structure. And I'll go through some of those benefits later on. And it really comes down to customization of portfolios. So if we can go to the next slide. So the product or the portfolios that we deliver, they sit within a dynamic asset allocation strategy. There's essentially 8 core portfolios that we run. One set of risk-adjusted models, which are ETF focused. They're our flagship portfolios. They run through 1 through to 5 on a risk-adjusted basis. And that's the predominant amount of our FUM is in those. We also have a set of direct equities portfolios. They also sit under the same dynamic asset allocation capabilities that are in-house from Implemented, but we have security selection provided to us by an external provider, Joseph Palmer & Sons. Now, these models are available either on a platform such as NetWealth or BT Panorama, or in-house on our own custodial service, which we call IP Direct, essentially. And we can go to the next slide. So one of the big differences in how we deliver our portfolios is that we do it in an IMA. The IMA, essentially, we see that as a method that allows greater flexibility. And that means both from a model manager's point of view and flexibility for them. And the big thing there is being able to treat old money different or new money different to old money. So if the manager, is happy to hold something but doesn't necessarily want to continue buying it for new accounts, we can implement those instructions. Other individual settings that we see quite common are sort of at the advisor level. So an advisor may decide, we really like what you do from a dynamic asset allocation standpoint. We're not that great. We're not that happy with your selection on the small caps manager. Can you please substitute your small cap selection with this small caps manager, but continue to manage those weightings as they change over time. The third area where an IMA really comes into its own is individual customization from the client level up. So each client will have different requirements, different needs, whether that's transitioning to a portfolio over different tax years so that you can manage sort of tax positions, whether it's wanting to hold certain exposures to things that we don't have in our models, or having existing holdings you want to correlate to what's in the model to reduce transactions. So being able to implement all those individual changes at an individual client level allows for that greater flexibility. We look after close to 4,000 accounts and manage about $1.8 billion, obviously. That individual level of customization at an account by account level, it requires a lot of technology for us to be able to do that. And to be able to rebalance every account on a daily basis and make changes quickly, it really is bedded down by technology. We'll get into the technology a little later on, but if we go to the next slide. When it comes to the execution, given that we do have money on platforms and we also do have money that we manage on our own custody, we actually look to control all of the execution ourselves. So we'll take a data feed from the platforms every day, we'll put it through our technology and our rebalancing engines, and then we'll go out to market for execution. We like to control that execution rather than having it go out to platforms. One of the big reasons for that, though, is the vast majority of our FUM is in the ETF models. We've been trading ETF models for over 10 years. We do see ourselves as a bit of a specialist in that space. And when it comes to execution, particularly on ETFs and global ETFs, there's a number of different methods to execute those orders. And depending on which jurisdiction you're in will depend on how you are going to execute or what the underlying holdings are. So a good example of that recently, we reduced some exposures through our broad-based Asia exposure. It's a ETF which is 3010 listed in Hong Kong. Now, the underlying holdings in that ETF, they go across multiple time zones, multiple currencies, multiple markets. So depending on what time of day you trade, the spreads in the screen will be different, but also understanding what the market makers through Asia are currently holding on their books will allow you to know whether you can trade at NAV, which is no spread at all. So in that case, we knew that there were some market makers in Hong Kong that currently had some inventory on their books, and we were able to trade on NAV without a spread. On the flip side of that, you go to the UK, which was actually the other side of this trade, and you're looking to purchase an ETF. You may not go through a creation process in the UK. And one of the big reasons is because of the underlying taxes charged on the underlying holdings that the market maker has to hedge themselves out with. So in the UK, typically, if you're buying into an ETF there, you won't typically go through a creation process in the primary market. You'll look at the secondary market to try and execute because the spreads are typically narrower in the secondary market. So it's that sort of deep knowledge of different marketplaces and the markets that we trade in where we think we can add some value on that execution. It's one of those things, though, which is sometimes it's not really noticed by the end client. It is very small. It's really making you're trying to save cents here and there, and the end client being a retail mum and dad typically, they're not the things that they're going to notice. So it's something that I get really passionate about, but understand that my audience normally doesn't even recognize it's going on. We can go to the next slide. So to try and bring this all back together, and it has been a very brief overview of some of the things we do. As I mentioned earlier, there's technology really underpins what we do. We have, quite a lot of scale. We have, 2 portfolio managers essentially managing all of these accounts and all these individual settings. Then they have the inputs from the model managers and the likes with the models and changes that are happening to those models. And that's coming across multiple different platforms. So a big part of our technology and the technology stack, which you can see is quite busy on this diagram, is making sure the data is talking to the right areas at the right time. And we know where the gaps are in timing and that management. So Salesforce for us is, our source of truth for all client data and client instructions and things like that. And it's not an out-of-the-box Salesforce. This is a highly customized. We have a guy in the office who's, a specialist in this area. We're continually improving that. There's a great deal of automation and sort of process-driven flows that happen out of Salesforce. That sort of is our source of truth with all client information. It's also a funnel for instructions that come through and get designated out to certain tasks, to certain teams. We then take portfolio data and holdings data from a number of different places, and that feeds back into SS&C for our rebalancing. And that's where we can run those rebalances, have all those individual rules set, go out to market, trade, and then allocate out for all the individual clients at the end of the day. There's obviously a lot of other components. That's just one small part of the business, which is about doing the rebalance and trading and making sure the model mandates are all in line. At the back of this, pushing information to different reporting systems, pushing information through to different teams in the business, whether it's management reporting, whether it's sales teams, to notify them of what's happening in models and how things are changing. We could talk about these topics for quite a long time, but I do know there's a bit of a Q&A afterwards. So I'll probably leave it there, Nancy. I'm rapid to get through it, and then we can go to questions.
Sure, no worries. Thanks, Chris. But we do have a couple of questions from the audience for you. If you don't mind answering one of the questions. In regards to IMA, how does that work with advice process such as a SOA or ROA generation provided with each change, and what scale for an advice business?
Yeah, it's a good question. And it's one of those things, our mandates for the managed discretionary accounts and the models that we run, it's a dynamic asset allocation strategy. So it's quite a wide mandate for the asset allocation. So you're able to, the vast majority of those decisions are all within that. So you won't have to write another ROA for most practices. If you're going in there as an advisor though, and changing a portfolio significantly away from our mandates, then your licensee may require you to do it. But it's really a licensee's question of whether you're required to write an ROA. If you're going to go in and say, right, I want to exclude all of your risk assets and only hold the defensive side of the portfolio, but you've allocated the client to a high risk, then you probably need to get some sort of advice on that. But the vast majority is covered within the mandates.
Okay, thanks, Chris. And secondly, with the IMA, do you take into account individual tax considerations for each client when considering trades for each portfolio?
Yeah, we do take into account tax. It's one of those ones which is it's the third thing we look at realistically. If we're looking at valuations of a particular asset and whether we want to buy it or sell it, if we get to a point where the valuation is, we need to sell this thing, it definitely should be sold. Waiting for a tax hurdle for 12 months to save yourself 15% versus being at risk at a lot higher, we weigh that up. One of the great things about it being an IMA is we can make decisions and implement them over time. So the model manager may say, I want to reduce exposures to Australian equities. I want to do that over 6 months. So we may look at that trade and say, right, we'll do at least a sixth every month. In that case, we'll have a look at the underlying holdings that we're selling. And for those accounts that are within, 3, maybe 4 months of a 12-month CGT discount, we may just hold off the selling for those until they've ticked over that 12-month mark. And we have a number of procedures and systems and where systems can't quite keep up with that sort of stuff, we have a number of different processes and spreadsheets that glue all those smaller details together.
Okay, thanks, Chris. That kind of answers another question that someone had. What software are you using for analytics and asset allocation? Do you want to dive into that a little bit more?
On the asset allocation side of things, that's our investment committee is really responsible for that. How they use a variety of things that most fund managers use. Your typical Bloomberg for data and various other data sources, and then the realities is that there's a lot of spreadsheet work. That's how most models have been built over the years, and very few people have moved that side of the business further on than spreadsheets for valuation work and that attribution analysis, essentially.
All right, thanks, Chris and Adrian, for both of your presentations today. We're just going to move on to Q&A. So I'll just start with Adrian first. We have a number of questions here. Firstly, because you use platform technology for rebalancing and transacting, you're kind of at the mercy of whatever they build and however they operate. How much difference is there between their operating processes? So does this result in significant differences in outcomes for clients, for example, in cost of trades or achieved prices?
Sure. Good question. So we've kind of become platform experts over the years. And there are certainly some platforms that we aren't on because they simply do not have the capability or the technology that we need to do what we do. So, for example, some platforms don't have a direct international equity piece yet. Some platforms don't have that models of models technology that we need. But the platforms are all, in a race to continually evolve. So they're all kind of always catching up with whoever the leader is at the time. From a transacting perspective, that's really interesting, and there are quite a few differences from platform to platform. So we need to be aware of that. With the trading window for some platforms, it'll close at 10 a.m. in the morning. So if we're making a rebalance, we need to get that in by 10 a.m. in the morning. For some other platforms, it's lunchtime. And for some, as I mentioned, we can pull the orders out and transact ourselves over the course of the day. So you do sometimes get a little bit of drift. For example, if it might be executed one day on one platform and the next day on another platform. There's also a pretty big difference. One of the things that can be difficult in the SMA structure is rights issues, entitlements, or new issues. So that gets a bit technical. For example, if there's a new issue that we want to bid for stock based on a certain allocation for a portfolio that we have on multiple platforms, then you end up getting your allocation, need to adjust your model weights and get that settled through different platforms. So so there is a process with all of them, and we kind of know which ones do certain things well and which ones don't do it as well. But as I mentioned, they're all getting better and better and better. From a transaction cost perspective, none of the platforms that we use have individual transaction costs. So it's just a flat brokerage rate. For us, that's really important because of the nature of what we do.
Okay, thanks, Adrian. And over to you, Chris. Just a question here. Because you're calculating portfolio changes based on data feeds from platforms, how reliable is the data which you get from them? And how do you deal with the fact that transactions can be quite delayed?
Yeah, so depending on the platform, again, it's a common theme. Each platform does something differently, and they deliver things at different times, or they deliver things in different ways for different services. Will depend on how we manage things. So we do have some hurdles where you have a delay, but we essentially capture all the data that we have on a daily basis. So we'll capture every single piece of holdings on a daily basis. We'll capture all the trades we do on a daily basis. So in the instances where we do need to, or we want to trade and we want to do a calculation earlier in the day, we can essentially utilize the data we've stored to give us that position to then go out and do those calculations and then do those trades. So although we could, we're getting a blackout essentially from the data coming in, we've essentially got a fictitious position which is accurate. And we can work off that until we get that data at a later point in time and can confirm it back. It is complex. It's not ideal. And, at some point in the future, hopefully, data, there's been a lot of talk in the market, we're going to API this and we can go straight to the link to this. And the realities is that most don't have that facility. It's not available on every single data point. And I think as financial markets and financial services gets more sophisticated, we will get more quicker data and more often. So that'll happen over time.
Thanks, Chris. And a question for both. We'll start with Adrian. This is, I guess, quite technical, but can you explain what role a market maker plays in the transactions on ETFs and how you interact with them, particularly in smaller, less liquid ETFs?
Yeah, look, good question. And Chris, I think, covered that reasonably well and probably knows that space better than us. But we do use ETFs. We do use ETFs for some of our rest of world global equity exposure, for global credit, global bonds, a few of those sorts of things. But it is an important point. If you're transacting on market, you can wear a reasonable spread. And if you're in really volatile markets like we saw in Feb and March, those spreads can blow out quite a bit. So it's important, and we've done this, as Chris just mentioned, that they do. There was a recent example of a relatively new ETF that we liked, put a reasonably meaningful weight into the portfolios. Now, we executed that through one of our brokers, but they were able to get in touch with the market maker, and we had the units issued at net asset value at the end of the day. So it wasn't put through the market. They were new units that were created at NAV. So the important point there is to just understand the spread, the liquidity, and be able to talk to the market makers to make sure that you're getting the outcome that you want.
Yeah. Well, Chris, you did dip on it during your presentation today. Is there anything you'd like to add?
Yeah, it's not too much more to that, really. It's one of those components where, with all ETF trading, you're really looking at what you're trading as the underlying basket. You know, the ETF is a great wrapper to give you a really easy way of accessing those underlying securities. And so when you're looking at liquidity, you're not just looking at the liquidity of the ETF trading, you're looking at the liquidity of the underlying holdings. You're looking at the markets that they're trading in, understanding what times those trade. If they're large caps, maybe you can, the market maker can hedge with a futures contract. So you may have more liquidity throughout a larger time frame. So there's a lot that goes into it. And it's just making sure that you do the proper due diligence, understand who the people are that are trading those vehicles, and approach those to create competition. You ask 3 market makers, you get 3 different prices, your spread's going to come closer. So it's about creating competition in the marketplace to get the best price.
Okay, thanks, Chris. Someone else just added a question on top of that. Chris, for yourself, if you do the execution outside the platforms, how do you push those transaction records back into the platform?
So there's an end of day process where we send them an allocations file. That allocations file is, a spreadsheet essentially with account numbers and units that are going to be allocated to that account. And then, the contract notes that come through either from whichever broker we're using will come through to us, and also the settlements team at the relevant platform. So then they'll be able to allocate out and settle.
Yeah, thanks, Chris. So just on ESG, I guess, Adrian, I think you did mention about ESG considerations into portfolios in the future. So a question here is, building ESG considerations into portfolios is a major requirement now, but it's made more complicated by the variety of ESG approaches which individual clients or advice firms want. How do you accommodate ESG considerations into portfolios?
Yeah, okay, so I'm going to spruik managed accounts a little bit here and the structure that we run, but I think managed accounts and the technology evolution is absolutely brilliant for ESG. One of the issues that all of the advisors listening will know is that ESG means something different to almost everybody. Some people are comfortable with resources, some people are not, for example. Some people are comfortable with gaming, some people are not. So, the issues that you guys have is, do you use a model portfolio structure? And if you've got ESG clients, do you have to set up a whole different portfolio to run for those? And then, is that ESG portfolio suitable for all of your underlying clients? Now, again, the platform technology, so most platforms now have substitution technology that the advisor can set up at the client level. So with our portfolios, as I mentioned, there's 130 odd underlying securities. We run a report that we give to advisors that shows all of those holdings at the start of the month. So they can then actually have a conversation with the client and say, hey, here's all of the companies. You know, is there anything in there that you're uncomfortable with? And they can then set up at the client level stocks that they don't want to own, and they can make a decision as to what they want to substitute that with, whether they want it rebalanced across the rest of the sector-based SMA or portfolio, whether they want to substitute it with another stock or an ETF just to get broad index exposure. And I'll also mention Praemium. So I mentioned earlier, the platforms are always, you know, leapfrogging each other with technology. Praemium have built a brilliant ESG filter. So they have 7 categories. So for example, there's one that is, you know, thermal coal and mineral sands. So the client can click that and it means none of those stocks will ever get in the portfolio. There's one that's a blanket oil and gas. There's global arms, global tobacco. So you can actually have a meaningful conversation with your client about what their ESG preferences are and then customize their portfolio. But in the background, you've still got the one model portfolio that you're running that has all the efficiencies and the same professional management. So I think managed accounts are brilliant for ESG, and that'll get better and better.
Thank you, Adrian. What about yourself, Chris? What are your thoughts?
Definitely agree that managed accounts is the space to be when it comes to being able to tailor and have these conversations with your clients on an individual level. Because whether it's through an SMA, using the technologies on the platforms, which is getting better and better, you can do that, or whether it's through, you know, an IMA like ours, which, you know, you can do a more tailored approach, but you get the same result. You can have those conversations with your clients. With us, we have a number of practices who essentially, you know, very early on, you know, decided they wanted a set of models that could be their ESG model or their E model. So again, taking our dynamic asset allocation, they like that. They like the communication that comes with it. They like the transparency, and then doing that substitution. So we can just manage that model for them. It's obviously a bit more involved when you add new positions or take positions away. You know, you have a conversation and consultation with the advisors to get a better understanding of, okay, we're moving more into the UK, and, you know, the spread between the UK and Europe's different. You know, what percentages you want to take. You sort of have that conversation. You work out where they want to go with their model. So it's been ESG is a tricky space because of the variation, and the definitions are different. So I think anything that has the flexibility to allow you to pick and choose is probably the best. There's going to be a large percentage of people who just want something that, okay, that's more or less in that line. That's great. But then there's going to be specific clients that need that tailoring. And that's where our IMA structure allows that.
Thank you, Chris. We have a few more questions from the participants. How do you, sorry, this is for both Chris and Adrian. We'll start with Adrian. How do you do your performance reporting for each individual client, and what software methodology are you using?
Okay, so we don't do performance reporting for individual clients. Now, with what we do, you guys, the advisor, are our clients. So we manage at the portfolio level through the investment manager's login. We can't actually even see the end client. So all we can see is the assets. So how much money is in each of the SMAs. We can see what's coming in and going out. You can run some reporting, and again, it varies a little bit from platform to platform. So you can run some reporting that shows us, you know, which advisors are using which mandates and how many clients they've got in the fund. But effectively, we can't see the end client. And as you would know, you know, the performance is going to be slightly different for clients based on when they come into the portfolio. But if they've been there for that 12 months or 2 years or 3 years, it should be almost exactly the same. It does vary slightly from platform to platform, but effectively, we run all of our portfolios through Bloomberg. So we get performance reporting through Bloomberg, but we also get the performance reporting, and the performance reporting that we quote is all off platform. So we get performance reporting on each of the sector models and the diversified models from all of the platforms each month. And we check that with what we've done. So it's all externally calculated. Now, again, the methodology gets a little bit different from platform to platform, depending on how they do it, and they do it a little bit differently, but most of them run a shadow portfolio. So when the portfolio started, it starts with a $10 million notional value. Then when we transact on the shadow portfolio or do a reweight, then they transact through market. They feed back the pricing with the transaction costs, and then calculate performance based on that shadow portfolio. And all client accounts are linked back to that shadow portfolio. So hopefully that answers the question. But we get performance reporting effectively from 6 different platforms and also calculated ourselves. And where I say there's some variance, the variance is really, it's minimal, almost non-existent over time, but it can be slightly different in the short term. For example, if there's a rights issue that one platform can do and another one can't, for whatever reason, there might be a slight difference in 1 month from one of the SMAs, but over time, there's very little difference.
Right. Okay. Thank you. And Chris, yourself?
Yeah, slightly different for us, but also a little similar. Given that we do use multiple different platforms, the individual client gets their performance reporting from that platform. For the stuff that we manage, we provide performance reporting through a portal essentially, and that can be broken up as the normal kind of performance reporting as you'd like through different time periods. Now, we do produce some monthly performance numbers as part of our investment capabilities and the fund capabilities. Those, given it's an IMA, we essentially take out the top quartile and the bottom quartile of those and provide an average of the middle 2 quartiles. And the reason being is, what Adrian's sort of touched on there, people in an IMA and in an SMA, people are starting at completely different times during the journey. So they should get different performance results. Also, they may have completely different tailoring. There might be accounts in there that, I don't want to own this, and this, and they may have been the best performing parts of your portfolio. So we sort of average that out and give you a statistically relevant sort of range of where things should be at, depending on what model you're in. So that's sort of how we approach that problem.
Okay, thank you, Chris. So just in addition to those questions, performance reporting done against a blended benchmark is performance reporting done against a blended benchmark across the asset allocation? So Chris, do you want to just touch on that?
Well, we're kind of benchmark unaware, so we don't really provide a benchmark. It's a whole model. Each advisor essentially can use their own benchmark as to what they think appropriate. But if you're looking at a dynamic asset allocation, or maybe it's similar to a real return fund, you can pick your benchmark which you think is appropriate for those levels of risk. So if you're in a number 3 portfolio and the max risk we can take is 70%, then you can pick CPI plus whatever it is, and then benchmark us that way. So we don't really typically look at benchmarks.
Right. What about yourself, Adrian?
Sure, we do. So we use the stock standard benchmarks for our sector-based SMAs. So the large cap Aussie is benchmarked against the 200 accumulation. The emerging leaders is benchmarked against the mid cap accumulation. Our international, we actually benchmark that against the MSCI and also the S&P 500. It's predominantly US stocks, so we benchmark against both. For the multi-asset portfolios, the conservative, balanced and growth, we benchmark against the Morningstar indices, and we also benchmark against the FE Analytics average. So FE Analytics run a benchmark which is the average of all of the portfolios in that sector, conservative, balanced, growth. So we benchmark against all of those.
Thanks very much, Adrian. So as you can see, we have 2 very different perspectives of how each of their businesses are run. Everyone has their own secret recipe in order to achieve the best outcome for their clients. So understanding the tools and which ones to utilize is very important to be able to construct a effective portfolio for our clients. That kind of concludes our Q&A session today, and I'll pass it back to you, Toby. And I want to thank Chris and Adrian for your time and knowledge today.
Thank you.
Thank you very much for having me.
Thank you.
Look, thanks very much, Nancy, and I'd like to echo her thanks to Chris and Adrian, talking about two very different ways of running managed accounts in a platform and in an MDA-based IMA approach, but both emphasising the role that technology plays. In our final webinar in the series next Friday, we'll be looking at client reporting, a critical part of making tangible the intangible service which portfolio managers offer, and some of the more technical aspects of risk measurement and performance measurement. So please join us next Friday, 2 days' time, when Chris Robertson from Arthur Austin Advisory, David Ryan from SS&C will join Nancy to talk about essentially the end point, the outcome of all the work that our portfolio managers do. So thanks very much for joining us today. I hope you found it worthwhile. There will be CPD points awarded. The slides and a recording of today's session will be available through the IMAP website. Thanks very much for your time today. Look forward to seeing you on Friday.